Deep in the heart of Tehran, far from the traditional global banking sector, a quiet, hidden financial network is humming. Western sanctions are designed to sever a nation from the US dollar. The logic is straightforward: block access to global banks and starve the state of the capital it needs to operate. But addresses linked to Iran's Islamic Revolutionary Guard Corps, the IRGC, moved over $3 billion in cryptocurrency during 2025 alone. That $3 billion is part of a larger ecosystem. Iran's total on-chain crypto volume reached nearly $8 billion last year, with the IRGC controlling more than half of all those funds by the fourth quarter. Tehran responded to financial isolation by engineering a multi-billion-dollar, digitally immune parallel economy. To understand how they generate this wealth, we have to look at the industrial scale of the server racks filling state-sanctioned mining facilities in the desert. Iran subsidizes its energy grid, providing electricity to mining farms for $0.004 per kilowatt-hour. This practically free energy means it costs only $1,320 to produce a single Bitcoin, far below the actual market price. This profit margin turns basic computer processing into a reliable, sanctions-resistant revenue stream for the state. The crypto output doesn't stay with the miners. By law, licensed operations must sell their digital currency directly to the Central Bank of Iran, which acts as the central clearinghouse. The central bank then converts this into usable assets. In 2025, they acquired over $500 million in USDT. USDT is a stablecoin, a type of cryptocurrency pegged to the value of the US dollar, allowing the bank to mimic the banned global currency for international trade. By holding hundreds of millions in digital dollars, the state can settle international trades, facilitate illicit oil sales, and purchase dual-use technical equipment while bypassing global watch lists. These funds help maintain the regime's influence across the region, providing capital that supports the operations of proxy networks, including Hezbollah, Hamas, and the Houthis. By bridging the digital and physical worlds, this system provides the regime with a constant stream of liquid capital to sustain its regional influence and proxy operations. Because this financial network is tied to the state's military activities, kinetic events on the ground cause immediate shocks online. We can track real-time capital flight on the public blockchain. Consider the events of February 28th, when US and Israeli forces launched targeted airstrikes against Iran. This chart plots withdrawal volume. Within minutes of the first explosions, withdrawals from Nobitex, Iran's largest crypto exchange, shot up 700%. Activity spread across the system, with hourly transfers surging 873% above the yearly average. By the time the spike leveled off a few days later, $10.3 million had moved out of Iranian exchanges. This pattern repeats during every major escalation. Analysts recorded similar spikes during the Kerman bombings in January 2024 and again during the 12-day war in June 2025. This massive surge in volume illustrates how Iran's crypto infrastructure reacts to the threat of kinetic warfare in near real time. Unraveling this evasion mechanism is difficult. The US Treasury Department is investigating whether global cryptocurrency platforms facilitated these state-linked transactions. Forensic analysts at TRM Labs have already pinpointed more than 5,000 specific crypto addresses tied directly to the IRGC's $3 billion network. But the problem is global. Sanctioned entities worldwide received roughly $104 billion in cryptocurrency in 2025, a nearly 700% increase from the previous year. The scale of these numbers suggests that traditional 20th century financial controls are struggling to keep pace with 21st century digital infrastructure. For the IRGC, as long as the servers keep humming, the parallel economy remains open.